Okay, guys, today we're talking about the R principle and how is it first way how you could make 1,000% of your money, how you could do that like consistently every week. The first thing is it possible to make 1,000% every week in cryptocurrencies? Yes, it's very possible. It is doable, and it is possible when you understand the system and how to do it. There's a system behind every success. There's a process behind every prosperity. So this is me this coming to provide to you guys the system behind this kind of result, the process behind this kind of result if you want to have this kind of result. Now, on a normal scale whereby people could think that, okay, let's say you decide to trade, what's it called, DeFi, you're trading decentralized coins and both shit coins, meme coins, and normal coins. Let's just say DeFi. You're trading DeFi on Uniswap, on BSC, and PancakeSwap. And now, buying those coins generally is more of, it is also possible to make 1,000% every week doing that. But to be honest with you, the only way, there is no uh, well defined system that could ensure you make 1,000% in quote every week in that kind of trading. It's more of anyone who is able to hit that amount weekly is in two categories. Is either the person is in a category whereby they are the ones creating the coins, creating the projects behind the scene and launching it, or they are working with those who are creating this project. Like they have direct access of information with the founding team, so they're able to get in at the earliest place. So if they are in this, so people who are able to do this consistently every week in the DeFi, this is because they are in this category. Now the second set of people that could be doing this are people who have a large appetite for risk and gambling. So this is why most of the people you see who are saying they're trying to copy whales and trying to make use of bots whereby the bot automatically copies a whale wallet and all that. One of the things you will notice most of the times is that when they're trying to copy the whale, they still end up taking a lot of losses. And they'll be why? Because that whale might have to take 100 trades for him to hit one good trade that is like peak, and his risk appetite is large, so he can chest the losses. But that one good trade he nails might turn to be like 5,000% or 10,000%, and maybe each of the trades he's risking like let's say $500, and then he's lost a lot of money. Let me say if he takes a risk $500 per trade and he loses like almost 100, that's almost a big amount of money. And let's say he hits one very well and he makes like 10,000%, he has made a whole lot of money that is even beyond what he has lost as well. So it is either one has an information directly from the founding team of the project, or the person is ready to do a lot of gambling and try and error and all that to see this game. So there's no literally like systematic way when it comes to that aspect. Although I have been working on coming up with a systematic way that will be consistent. Now, I'm not referring to research methodologies, research strategies, all those things are still falls under the category of, should I say, um, gambling. Let me use that word. Not really gambling, I say, or speculations. Speculation is not like this is a guarantee that this you can literally do this. I'm more what I'm focused on today is a guaranteed system that you know that if you can use this system, you are sure you can do this. It's more it's more of the better side than when you are on the aspect of say you are speculating. So research methodologies and all those strategies work, and probably you'll be able. That's why when it comes to that aspect, I approach it with a mid-term and a long-term basis. I approach as an investor because that is the surest way and the most solid way and the most certain and confirmed way that you can literally make a whole lot of money in that aspect. Every other thing is just gambling. But when you're approaching their projects have been holding for a year, their project have been holding for 3 months, some for 4 months or 5 months. By the end of the period of holding, I'm so confident, and it turns out to be very, very profitable for me. Profitable for me. Some of them goes to do 10,000%, 50,000%, and all that. So it covers everything. So it's something that is unique. It's unique. It is super. Is amazing. Before I continue, I want to know if you guys are hearing me. If you're seeing me, I want you to drop a comment. If you can hear me and you can see me, let me be sure that I'm not speaking to myself. I know I started a bit late today because of distractions I got, but let me know. Drop a comment. Let me know if you can hear or see, so I'm sure I'm not speaking to myself. Drop a comment if you can. Okay, so on that aspect, on that regard, that is like key. Number one, it's the fact that it's something you have to come to a place of what's the key word I'm trying to get now? A place of a mid-term approach, the investor approach, the long-term approach is what yields the largest rewards. So you can't be starting in that category. However, there's a system that we are working on to develop that can give a guarantee that okay, if you follow this, it will just be producing other kind of thing for you in that aspect. But pending that coming into scene, and pending that coming into play, let's go into which other aspect that we know can be more valid, which other aspect that we know can be more certain, that could project that I have used and I am using, and that anybody here can be said take this system and use it very well to replicate the result. And that aspect is the aspect of trading. And it is more possible because one, there are so many coins out there that you can trade. So it's all about you getting the right one in the right settings, and then you understanding the arrow principle. So with the right arrow principle, you can nail two trades and you can make 1,000%. You can nail two trades and you can make 1,000%. Okay, I can see your comments now. We are hearing you loud and clear. I can hear and see you. I can hear loud and clear. I can hear you, sir. I can hear you clearly. Okay. If you can hear me, click on the like button. Click on the like button. I don't know if there's a share option on YouTube. There's a share option. Also, do share the live. Do share the live and do click on the like button if it's available on the YouTube. You can share the link. Also, click on the like button as well. So let's continue. So basically, that is that is how you could literally do it. So I'm going to show you how I do it when it comes to trading because it's more systematic, it's more valid, it's more on the real side. So I'll show you how I do it when it comes to trading and how you can literally do the same thing and replicate having the same result. That's basically what I'm going to show us quickly on that. So, but first of all, we need to understand what the arrow principle is and how it applies to this and how you can literally use it to replicate the results which you need to have as well. You need to have as well. Okay. So let me see how I okay. The weird thing here is that I did not I'm looking for the photo. I don't know how to bring this up. So let me share the screen now. Let's go into that and let's look at the R principle. R principle. So I'm going to share this. I want to see how I can share it in a way whereby it is more visible. Now, if you look here, there are 4 steps to understanding the R principle. Basically, 4 steps. And um, I want to get us to understand these steps very, very well. I want to get us to understand it very, very well. Now, the first step here is for every trade you take, there are 2 things that you decide before you take that trade. For every trade you take, there are 2 things you decide before you take the trade. The first thing you're deciding is how high you think that trade is going to go and how much you're willing to risk on that particular trade. I repeat, how high you think the trade is going to go and how much you're willing to risk on that trade. Now, let's say I have $1,000 account and I want to be able to deal with this. I want to be able to deal with this. I get to I want to take a trade. So I'm willing to lose 10%, which is $100. Then I'll need to decide how high that particular coin is going to go. So I want to show you a case study. Now, if you have shared the video, so this is step number 1 I'm teaching. Step number 1 of the R principle is when you want to take a trade, you need to ask yourself, how much am I willing to lose? And what is the target I'm giving on this particular asset? So definitely, let's say you apply my strategy. If you have my course, which is the best course you can actually get when it comes to trading cryptos and every asset as well, that's the best course you can ever get. If you have it, it will be very easy for you. But if you don't have it, you can make sure you get it on the website. But now, the first thing you want to do is you want to identify it. So let me use the practical case study now. Let me use the practical case study on a token. So let me use this asset. How do I share the screen now when there is like others showing up already? Okay, I have to close this. I have to stop one so I can share the other. So let me use this particular what's the name, this coin as a case study. Let me remove this. Or how do I do this? Let me hide it. Now, if you look here on this asset, which is called, this token is called LPT. Now on LPT, there are 2 entries I am more positive on, which is this one here and this one here. Now, if you see this thing here that is showing the red and it's showing the red and it's showing the what's it called, the green. The green is showing the targets. The red is showing what I'm risking. And if you see here, there's what is called risk reward ratio. Now, this is showing that it is showing 8.71. 8.71. This means that I'm projecting that the price of this coin, my target is that this coin is going to go to as high as 8 point something dollars from where it is. And since I'm risking $100 and the risk to reward is 8 point something, it means that if it gets to where I am projecting and where I want it to get to, I am going to be making 8 times of my money. So I'm making 800% on my risk. Now, it is not always easy for people to catch trades that could give them 8x or give them 10x. So the safest way to go about this is to look for trades that could give you 5x. With 2 trades in a week that gives you 5x, you easily get 1,000%. But you won't even be able to get this trade when, one, you don't even understand the arrow principle, because the arrow principle is like the foundation for this. It's the foundation for this. So the first thing here is that I have identified how much am I risking $100, which is on my $1,000, and the target I'm projecting, which is the where for that coin, is $8 and so, and that means I'm going to make it 8 times what I am risking. So if it gets to my target, I'm making 8 times. If it loses, I'm just losing my 10%. So already that is a home run trade. And I just need 2 of these type of trades each week to make 1,000%. Now let's go back to the arrow principle, because there are 4 stages to it. So what I shared with us now for now is the first step is what I just shared. Now step 2 is when you've identified where you're targeting from your entry, where your target is, and you've also identified what you're willing to lose. Step 2 is calculating the risk to reward ratio. The risk to reward ratio, which is basically the profit percentage you are getting divided by the stop loss percentage. It should be greater than 1. Greater than 1. That is what now what we say it is equals to your sizing, which we'll talk about the sizing also. The profit percentage divided by the stop loss percentage should be greater than 1. I just want this to be in a way that is actually going to be very easy for us to understand. So I'm explaining. I'm going to be explaining the step 2, step 3. Now, step 3 is all about calculating the sizing, which is what you want to now risk. What you want to now risk. So let us go into step 1 and step 2. How do you calculate your risk to reward ratio, and then how do you calculate sizing? How do you calculate sizing? So let's get to that aspect now. We'll go back to this same trade we're using as a case study, which is LPT, that we're using as a case study. Now, or let me use a different, I will still use LPT, then I will use a second trade. Now, if I come here on this trade and this token gets to this place, I will enter a buy, maybe a long on futures, or I decide to buy on spot. And I set a stop loss of 4.527. Now, when I am setting this stop loss, automatically on any exchange I'm using, it's going to show how much I am going to lose if I get stopped out. How much I'm going to lose if I get stopped out. Now, that money it shows how much I'm going to lose if I get stopped out is what I am risking. My margin is not the problem. My equity is not the problem. What I will lose when it hits the stop loss is the problem. That is the risk. That's how I calculate it. So when I put in the profit, what it shows there that I'm going to get when it gets to the final level, that is the profit. Now that is the risk reward ratio. So in other words, if you take the sizing, which is $100, that is the loss, $100, which is a stop loss percentage. The profits is $800. $800 divided by 100 is still greater than 1. It's like into 8 places. That gives the risk to reward ratio. What is my risk? $100, which is 10% of the $1,000. Now, it is stated for you to be able to hit this weekly percentage, you shouldn't take any trade which the arrow principle of that trade is below 1 to 5. Any trade that is below 1 to 5 does not suit this strategy. It doesn't suit the arrow principle, because your target is that if you get 1 to 5 2 trades, you could nail easily 1,000% in a week. So this means your account size can grow by 200 to 300% every single week just doing this alone. As simple as it sounds. Now, let me look for another possible case study that will be very, very powerful to and great to work with. Looking for a very good case study that will be good to work with. If you've shared the live, type the word shared. I want to see how many people have shared it. Let's see how many people that should be rewarded tonight. If you've shared the live, type the word shared. If you shared it, type the word shared. Let me know how many persons are worth giving much attention, and if I should give more value tonight, or I should withhold some things. What are we typing now? What are we typing? So let's use, let me look for an asset that we can use. Okay, there's an asset called what's it called again? Acro. Okay, so this is Acro, for example. Now let's use Acro as a case study too. Now on Acro, I did not share this trade to I didn't share this trade to on any platform. I didn't share it to the network. I didn't share it anywhere. It's just me. This is just my own personal trade, which I'm using as an example now. I didn't post it on the platform. I didn't post it to the Bybit network. It's just on my own account. I'm taking this trade, but I want to use it as a case study. I want this as a case study for you guys to see something. Now, if you look here on Acro, look at this particular trade, and if you see here, the risk to reward ratio is showing 7.12. That means if it gets to my stop loss, I would have lost $100. But if it gets to where I'm projecting, I will make $700. But remember, my target is just 1 to 5. So once it gets to $500, I can even close this trade. But if you look at here, it took from 29th of August to about 23rd of September for this thing to happen. So sometimes some of these we take up to 2 weeks, more than a week, for it to get to direction, but it will get to the direction as long as you know what you're doing. Now, if I use Acro as a case study now, and this gets to where I'm doing in the next 1 to 2 weeks, I would have made $700 if I'm just risking $100 on Acro alone. So in this part now, I wouldn't need to want to take too many trades. I don't need to trade every day, but yet I'll be able to hit my weekly goal and weekly targets. And if you watched what I taught yesterday, I mean the day before yesterday, which was forgotten the topic I treated that day, the last live session we had, I treated a particular topic, and I don't know why it's skipping my mind. But if you look at the topic and what I thought about the strategy there, now if you take that strategy and you're looking at it from the macro aspect, you begin to understand why this is very, very solid and very, very super. Very, very super. So it's on a very comfortable basis whereby one can go on with their daily lifestyle. You can go on with the things you want to do with your work, with your job and stuffs, and yet without hitting your head on the wall, always wanting to look at your phone. In fact, if you want to look at your chart to check your chart, maybe you might just decide to check it once a day, once in 3 days, once in 2 days, and all that. Or so, from not like every second and all that, and yet you'll be able to hit your goal and hit your target with this particular kind of strategy when you understand the arrow principle. When you basically understand the arrow principle. So you're talking about sizing. Your position sizing is what you are willing to risk. Now let us look at what we call the last stage of the arrow principle, which is what we refer to as profitability matrix. Profitability matrix. And pay attention to what I'm about to say, because if you miss what I'm about to say, you have missed everything. In fact, this thing I'm about to teach now is like the most important of the arrow principle. The most important of the arrow principle, because many people do not understand this, and that is why they almost lose all their money from time to time. They are literally able to stay consistent in their wins. And when you get this, you're going to be on the winner side. You're going to be on the more profitable side. You're going to be more consistent in your growth and in your progress, even in your trading. And the result you are going to be seeing in your life and your financial life and your capital to be able to do whatever you want to get done. Now, let us the profitability matrix is what I want to talk about, which is the fourth stage, and then we'll do a summary of the whole thing again for us for a better understanding. Let's look at the profitability matrix. Profitability matrix. Profitability matrix. And what does the profitability matrix do? What does it project? Now, the profitability matrix shows that we have, for example, 5 kinds of traders. Traders that are only correct 20% of the time. Then we have traders that are correct 30% of the time. We have traders that are correct 40% of the time. We have traders that are correct 50% of the time, and traders who are correct 60% of the time. 5 kinds of traders: 20% of the time, 30% of the time, 40% of the time, 50% of the time, and 6% of the time. These are the 5 categories of traders. They are correct 60% of the time, from 20 to 50. So now the profitability matrix, based on the arrow principle, states something. It states that if you take trades that are 1-to-1, that means the risk of that trade is $100, and if it gets to the TP, you make another $100. That's a 1-to-1 trade. When you see 1-to-1, it means that for every $100 you're risking, you're getting $100. For every $200 you're risking, you're getting $200. That's 1-to-1. Now, it said that traders with a low trading margin, traders who have a 20% win rate, cannot be profitable with that kind of arrow. Traders who have 30% win rate cannot be profitable with that kind of arrow. Traders who have 40% win rate cannot be profitable with that kind of arrow. Even traders who have a 50% win rate, that means out of every 10 trades they win 5. The traders who win 5 out of every 10, they will get to what we call break even. They will be at a break even stage. So it will be like they are not moving forward, neither they're coming backward. They are break even. Only traders with a 60% win rate and above can even succeed with a 1-to-1 arrow kind of a trade. Then we have arrow trades of 2-to-1. We have arrow trades of 3-to-1, and then we have arrow trades of 4-to-1. Now, in 2-to-1, it means for every $100 you risk, you're targeting to make 2 times, double of that money, $200. For every $200 you risk, you're targeting to make 400. That is times 2 of that money. Now, if you trade like that, based on just 2-to-1, for every trade you're doing, every trade analysis, your stop loss, what you're risking, and your target level is 2-to-1. If you are approaching trade with such arrow level basis, and your win rate is 20%, for example, you will still not be profitable. If your win rate is 30%, you're not profitable. But if let's say even if you have a 40% win rate, then you can be profitable. You'll be profitable. If you have a 50% win rate, you'll be profitable. If you have a 60% win rate, you'll be profitable. Now, when your RR is at 3-1, with a 30% win rate, you can be profitable. 40% win rate can be profitable. But when it is now 5-1, from 4-1 to 5-1, which is what I'm telling you guys for you to be able to achieve what I'm saying. If you have a 4-1 or 5-1 trades with a solid win rate, you can nail 1,000% weekly. Very easy. Very, very easy. Just 2 good trades has given you 1,000%. Why? Because they are 5-1 or 4-1. Someone who has, even if you, let's say you lose, you have a poor win rate, your win rate is like 20%. That means for every 10 trades you take, you will lose 8 and gain 2. You will still end up profitable at the end of the week. Even if it's 30% win rate, that means for every 10 trades you take, you lose 7, you gain 3. You will still end up profitable. Even if you have a 40% win rate, maybe you lose 6 and you gain 4, you will still end up profitable. If you have a 50% win rate whereby you take 5 trades, you gain 5, you will still end up profitable. You have a 60% win rate whereby you lose 4 trades, you gain 6, you will still end up profitable. So in other words, this arrow principle strategy I'm giving is like the holy grail of your trading, whereby regardless of your win ratio, as long as you get your RR sorted out, it will be easy for you to always end the week profitable. Now, starting out, you might struggle a bit, you might have less result a bit, but when you assimilate what I taught and begin to apply it, you will never have a week whereby you will end worse or end terrible. You only have a week to be profitable. Maybe when you start, maybe at the end of the week, you're making like 200% per week, or 300% per week, 400% per week. Now, I'm not referring to all those percentages you're seeing on futures. Sometimes all those percentages can be deceptive. Your futures could be showing you 500% on this, yet the trade has not gotten to the RR level. Where the RR is decided is not the percentage you're seeing on your futures account. It is decided on the charts, on your trading view chart, on your trading view platform. That is why if you're here and you haven't got access to my course, do everything you can to get that course tonight. Go to the website www.howuniversity.org and get the course and begin to go through the course, because some of this, how to understand trading view and all that, is explained there in the course. It's going to help you very, very well. Now, let me cleanse. So there are 4 stages. Identify what is your target on that trade and what is the stop loss. The stop loss is what you're willing to lose. How much are you willing to lose? And the profit, your target is how much are you willing to gain. Identify your target and your stop loss, which is number 1. The stop loss is how much you're willing to lose. The target is your profit, how much you're willing to gain. Then your sizing. How much of your capital are you willing to take on this trade? 10%, for example, of your capital goes into it. That means if the trade hits the stop loss, you'll be losing 10%. Then the profitability matrix. The profitability matrix it's all about your win rate. How your win rate is. The level of win rate you have. The level of win rate you possess. So let me use this as a case study. Now, let me say this trade, I'm on this trade. And let's say this trade goes favorable. And I have $1,000 account. And I'm risking 10%, which is $100. If this trade goes favorable for the next 1 week or 2 weeks, the 100 last year would have ended up giving me about $700. This is 1. Then let me say I go over to this trade, and let's say Bitcoin dips and drops and whatever, this other second one now gets activated. If this second trade gets activated, the target here is 1 to 8. Or maybe it takes the next 1 week or 2 weeks to play out. And I'm risking the same $100 here. That means the $100 would have given me like $800 on this. That means I've risked just 20% of my account, and I've ended up making how much now? $1,500 on just $200 with the arrow principle and the high profitability matrix on a high profitability matrix. So if I decide to do this every week, what happens? Despite my day-to-day activities, I could take a break. Because why are we trading? Why do people trade? We all want a better life. You want a better life. You want to be able to live a better life. You want to be able to be comfortable. You want to live the life of your dreams. You want to be comfortable. You want to live the life of your dreams. You want to be able to go anywhere you want in the world. You want to be able to travel to anywhere you want. You want to be enjoy. You want comfort. You want luxury. You want to be able to meet your needs. You want to be able to help your loved ones. Money. And you want to do this not because you love trading. It's because you love money. So I'm not trading because I love trading. I'm trading because I like money and I want to make money. And now this means that if you can have a system whereby you don't have to be trading every day, but yet you can still make money, why not key into that system? And that system is the R principle. The R principle is what I call the regulatory principle. R stands for regulatory principle. So I call it the regulation of your trading. The R stands for regulatory principle. So when I say the R principle, I mean the regulatory principle. The R stands for the regulation of your trading. And when the regulation of your trading is guided in these 4 categories and 4 steps I just shared, you can literally utilize it very well to check the trades you take and how you take the trade, and it will help you very, very, very well. Now, there are people who use this same thing, but they do it on a smaller time frame. Maybe the 15 minutes, the 1 hour, the 30 minutes, and their trade, and they active trade, and they see makes your level of progress. But the thing at time is, those people, their profitability matrix is not as high as mine or ours, because on the smaller time frame, when it comes to cryptocurrencies, it is very risky, and it is like it's like a gamble that not everybody have time for that adrenaline rush. So it could be very manipulative and volatile, But if you use the strategy I teach, you're going to be on a winning edge because it's on a macro time frame that encompasses and swallows up the risk. So the risk that you should have experienced, the risk you should have, you no longer have need for those risks. You won't even be victims of those risks, because the volatility, the whatever drama is swallowed up in within those time frame, and yet to end up moving up to favor you in your direction without you sweating it up. That is how the arrow principle works, and it's something you can use consistently over and over and over again, because that is how you get better. You get better at using a thing when you become consistent with that thing. You become consistent with that thing, you get better at it. It's all about and the key to, you want to become rich in crypto, you want to become rich in trading, I want to become rich in investing, is having foresight to be able to know this is what is going to happen ahead of time, and then you position on it to be able to see how profitable it can get. And when I started, I talked about the other aspect of trading, which is not concrete. You're not 100% certain. It's like you're gambling. And then I'm talking about this is more concrete, because this is what you can literally use on the chart, valid, check your chart, and that will literally take your steps, make your decisions, and make your money. This is how the R principle works. So the video is going to be left on the YouTube platform. You can always rewatch it and watch it again for a better understanding. If you still don't understand how it works, watch it with the explanations I give. the interpretations I gave. It is very self-explanatory, very simple with diagram I used to share each of these 4 steps for us. And I hope it becomes a weapon, and I look forward to seeing your testimony on how you've applied the R principle even this new week we are in to make money. So by the next crypto capital show, which is going to be in the incoming Sunday, before it happens, you should already have your testimonial product or testimonial on this was what was taught, this is how you applied it, and this is the results that have been done. Your testimonial is what is going to keep me coming up here to share this with you. The 1%, the 2%, the 3%, the 4%, the 5% that are going to have their life change and become really, really rich is going to be worth the time I'm taking out to put in to share and give this information to you guys. So I wish us a happy weekend and a happy relaxation time and a successful week ahead of every one of us, because it's a Sunday and the first day of the week. So this week, 1,000% is the portion for everybody here. And even if you do not do this well, at least you should be making at least 500% with what I just taught you guys. Peace out and bye for now, fam.